Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, March 16th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see that futures are mixed. Dow futures down 70, S&P 500 futures down about 4, NASDAQ futures, however, up about 40. So we got pretty good action in the NASDAQ area, and we've been seeing that rotation into the more aggressive NASDAQ for the past, really since the beginning of the year. But even throughout this downtrend that the market has experienced since mid-February, we're continuing to see rotation in a positive fashion. Whether or not that plays out into something more bullish down the road, we'll wait to see. I believe it will, but that's just my thoughts. Let's go through today's agenda. Things we'll cover in today's show. Going to go through the daily market recap, talking technically. Let me give you an update on relative strength. Got a few companies to go through in the earnings spotlight, and then we'll wrap up with the three you must see. First, let me take you over to Earnings Beats, where if you go over to earningsbeats.com, if you're new, make sure you scroll down, check out our Earnings Beats Digest newsletter. It's a free newsletter, no credit card required. You can unsubscribe at any time. It's published 3 times a week, Mondays, Wednesdays, Fridays. Very quick read, usually just one chart and a couple paragraphs to go along with it. Try to make it very educational, focusing on the things that are important to us, like earnings, gaps, relative strength, and so forth. All you need to do is type in your name, email address, hit that subscribe button, and we will get you set up. Let's go ahead and jump in. Daily market recap for Wednesday. We saw the Dow Jones Industrial Average down 280 points. S&P 500 down 28. NASDAQ actually up 6 points. So that was that rotation I'm talking about. Bifurcated action yesterday, but we saw the NASDAQ actually performing well. One other thing I'll point out is all of a sudden, even though we've been going down, notice that we're seeing the AD lines once again turn back up again. NASDAQ not far from breaking out. S&P not far from breaking out. Even the mid caps and the small caps, which yesterday set new lows, new multi-month lows, both of their AD lines starting to turn back up again. Don't know if this is the start of possibly an uptrend, but at least we are seeing money apparently coming into the market in terms of accumulation. Yesterday, mid caps and small caps both down very heavily. Mid caps down almost 2.25%, small caps down 1.66%. So those were your two laggards. Again, NASDAQ showing some relative strength. In the sectors, utilities, talked about this since the beginning of the month. We do a monthly seasonality report for our members at the beginning of each month, and we pointed out utilities love the month of March. Their relative strength has been off the charts. Look at the Dow going down, S&P going down, utilities going up. This is, I think, over the last 5 years, utilities outperformed the S&P 500 all 5 years by an average of 4 percentage points. And if you go back 20 years, the XLU has outperformed the S&P 500 75% of those marches since, over the last 20 years. So 15 of the last 20 years. So pretty strong seasonal performance over the last 20 years. Utilities, their best month in terms of relative outperformance is the month of March. So what we're seeing right now is really nothing new if you know history. Communication services up a little bit more than 1% yesterday. But to the downside, what really led the action was energy and materials. Financials as well. And financials obviously getting a lot of headlines right now with a lot of the issues in banks. But energy and materials, if you have been watching, I mean, energy's been in almost free fall. Wasn't that long ago, I was talking about a bullish ascending triangle pattern in play here. Equal highs, rising lows. Well, you don't confirm until you actually get the breakout. We never got the breakout on that. And not only that, but we broke the downtrend, went back up, retested that trend line, and then it has been straight down since, breaking down below these prior support levels. I mean, I don't see anything on the chart until we get down to about 68 now on the XLE. I mean, we got a little bit of gap support in there, but losing the pullback that we had in early October, this just doesn't look like a very good group. And, you know, I'm looking at the crude oil prices, And right now, today, we're up 17 cents, but we're at 67.78 per barrel. That's the lowest we've been since back in 2021. So we got some issues in the oil patch right now, and it's mostly because of the falling crude oil prices. But again, financials, just wanted to mention, financials down almost 2.7%. This has been a really long, steady decline and on a lot of volume. You can see there, I don't normally pay a lot of attention to volume on ETFs, but when you see this kind of volume, you know there's a lot of attention in the area. And we've been seeing that move away, money rotating away from the financials, away from materials, away from energy. See the heavy volume, prices dropping. Communication services going up on heavy volume over these last few days. So that rotation is very bullish right now. It's moving into aggressive areas. We've been seeing it in technology, communication services, to a lesser degree, consumer discretionary. I'm going to go over all of those areas when we take a look at the relative strength in just a bit. Moving on to the 10-year Treasury yield. So later this morning, we will be getting a couple of economic reports, key economic reports. We'll have housing starts and building permits out at 8:30 a.m. Eastern, along with initial jobless claims. Of course, they come out every Thursday morning. But we'll see how the market reacts. Looking at the 10-year Treasury yield, we were down 15 basis points yesterday, but we were down 26 basis points at the low. So we rallied off of the low. If you look at an intraday chart, you'll see what happened. We went down, took out, put in another new low, and then rallied back. But I would say the overall downtrend, short-term downtrend, remains in play. And this morning, the 10-year Treasury yield's down another 5 basis points to 3.44%. So heading back down, you want to watch 337, because if you go back to that longer-term chart, this is a 1-year chart, you can see 340 here in December. 337 has been the low candle body in both January and early February. Excuse me. So that's a level to watch. We got down to 338 and change yesterday. Again, today we're at 344. We'll see what happens, whether or not we break down. But this is an interesting development. We're talking about, more on the long end of the yield curve. We start talking about the 10-year Treasury yield. That's been coming down. That tells us the bond market's not really concerned about inflation, and yet that's the reason the Fed's been raising rates. That's the reason. It's the inflation. They're worried about inflation. Bond long-term, or the long end of the yield curve is saying, don't worry about inflation. What's the Fed going to say on Tuesday and Wednesday of next week when they meet? Now we've got banks struggling. Personally, I think it would be a massive mistake for the Fed to raise rates on Wednesday. I can't see them doing it. But right now, the market's disagreeing with me, still kind of banking on a 25 basis point hike. I don't think the market's going to take that well. I think if the Fed raises rates, I will be shocked if the market handles that well. So we're getting a little bit of a rally right now in, certainly in the NASDAQ on a relative basis. I'm not sure that holds up, though, if the Fed stays its course of raising rates. It's just pure conjecture on my part. We'll see what happens next week, but I am a little bit concerned. I hope the Fed will tap on the brakes and at least just pause because of what's taking place in banking. There's no real rush. I mean, we just saw the PPI come out yesterday. It was way below expectations. CPI came out the day before. It was right at expectations. We're not seeing anything that is showing runaway inflation right now. I think the Fed needs to cool it. We'll see. All right, moving on to talking technically. Let's look at the S&P 500. For the third day in a row, we've closed above the open. So we're getting a lot of not so great news. The market's not starting off very well, but we're seeing buyers during the day. And that's what I tend to follow pretty closely. So anyway, we do have nice performance throughout the trading day. And so if you look at that on an intraday basis, just a 5-day, 10-minute chart, well, I mean, we gapped down we didn't have the intraday data on some of our indexes and ETFs over at StockCharts. They were having issues with their data vendor. But early on the morning on Monday, if you remember, we had a big gap down. We were down more than 1% at the open. I think the Dow, which at one point was down 600 or 700 points, ended up opening down 400 or 450, something like that. But anyway, the S&P dropped more than 1%. I think we opened down around the 3820 area. I'm just kind of guessing or trying to remember, but we were somewhere down around there. And you can see we rallied back up to almost 3,900 intraday. So it was a big rally before seeing some selling at the close. Then on Tuesday, we gapped up, traded up in the morning, looked like we were going to give it all back. And then all of a sudden into the close, big rally again. So we finished above the open. Then yesterday, we gapped down, trading back down below what we can see here, not quite down to where we were at the open on Monday, though. But it was a down day, pretty bad down day until about 1 o'clock. And then the afternoon, here come the buyers again. This is not the way distribution happens. Study the market. When you're going through a period of distribution over the long term, you are seeing consistently or consistent selling throughout the trading day. It's not just at the opening bell. We had real selling back at the beginning of 2022. So if we pull up and look at that 5-year weekly chart, from here to here, if you go back and look, intraday selling was very apparent, open to close. Since then, we've been going sideways. I know a lot of folks, we've been going through one bad news story after another. Got a lot of bears thinking this is it. Well, from when the bottom was called, when I called the bottom in June, we're still higher than we were back then. Say what you want. Somehow the bears think they're still winning. I mean, I guess if you flip your chart upside down, maybe you are. The bears are not winning right now. Are the stories great? No. But what do you get from it in terms of price action? I mean, what I'm getting from it, from the ultimate low in October, we got to move up. We got to move down. We got a new move up. We got higher highs. So far, higher lows. You got to take out about 3750 on the S&P 500 to even begin to entertain the idea of going back to that October low. If you don't get below 3750, it ain't going to happen. That's a guarantee. It's got to go below 3750 first. That would negate the short-term uptrend. So at least keep that area of support in mind. The NDX, NASDAQ 100, is looking even better. I mean, we printed a piercing candle on Monday after the big gap down. We rallied back. It looked like we were going to have a bullish engulfing candle. And then we saw a little bit of selling in the afternoon. So we ended up with a piercing candle. Still bullish, just not as bullish as a bullish engulfing candle. But off of that, gap up, continue move up. Then yesterday, gap down, and we came right back up and set a new high. So the last 3 days, this week, in my opinion, has been very bullish action on the NASDAQ. You might have a little bit of weakness in the morning, 2 different mornings, but look at those hollow candles. It's been buying most of the day. Look at the volume. It's not just been moving up during the day. It's been moving up on big volume. That's not distribution. I would be watching, this breakout here. I don't know, 11,650, something like that. Recent low, maybe 11,700. That range right in there is what I'd be watching. We've still got now 600 points to the downside. We got a little cushion at this point for any more bad news that comes out. Hey, if we break back down, we break down, we'll start looking more like we're going to go back to those earlier lows. But right now, that is not what's going on in the market. We'll see what happens from here. And then, by the way, I've been saying it. This is the opportunity. All the bears out there, gather your forces. Because February, the second half of February and throughout March, this is when, if the market's going to go down, in my opinion, this is when it's going to happen. I don't believe you're going to see it heading into earnings. It's really kind of funny, in my opinion, because you get all these analysts that'll come out almost every earnings season and say, this is the time, this is the quarter, this one's not going to work out well. Earnings are going to come in way below expectations. And then I watch 70 to 80% of the companies come out. Well, maybe that might be a little high. Maybe 60 to 70% of the companies come out and beat estimates. Happens every quarter almost. I don't think this upcoming quarter is going to be any different. And I think we're going to see a pre-earnings run up. That'll probably start later in March or maybe early April. Let's keep moving on. I want to talk about relative strength. So we're going to start off with sectors. Look at technology. Folks, I don't make this up. I'm showing you a chart. You can be bearish all you want, but technology since the beginning of the year is soaring relative to the S&P 500. You know, we're almost to an all-time high, technology versus the S&P 500. This is almost the best it's ever traded on a relative basis. And you got everybody bearish. Why in the heck would folks be moving into aggressive technology stocks if the economy's so bad? Why? Nobody's really explained that to me. When you see relative strength like this in technology, Wall Street's prepping for something much better down the road. So we got all the analysts coming out to CNBC. It's the greatest conflict of interest in history. But you got all these analysts coming on to CNBC talking about this is bad, that's bad, it's horrible, the banks this, inflation that. We got the Fed, they're hawkish, blah, 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 blah. Meanwhile, certainly looks like Wall Street's moving into aggressive areas to me. That's just technology, but let's keep going. Consumer discretionary. It's pulled back a little bit since maybe the first week of February, but it's way off its low from back in December. And I would be watching this. If this goes back up and takes out that recent relative high, that would be a very, very bullish development for the market. So keep an eye on that. Hasn't done it yet. Went back below that 20-week moving average. Now it's trying to get back up above it. That would be bullish. Can we move back up and take out that relative high? That'll be something to watch. Communication services. I mean, it's turned around. It was the worst performing sector for about maybe 13 months, 13, 14 months. And it's turned around. We now have the relative PPO in positive territory. That's relative bullish momentum. Moved up, pulled back, held the 20, and now trying to break out again. These three that I just showed you, these are the three key groups to watch in the stock market. And I'm seeing pretty good action. Industrials coming down a little bit, but I'm not surprised. Usually industrials and financials move together. Now, financials have taken a tumble. I mean, big time. Of course, we don't need a chart to know that. If you've been watching price action, you have a real good idea, especially in the banking area. But huge move down. We're going to see if this triple bottom holds on a relative basis. If it does, that would be much more bullish for the market. If it doesn't, that could add to some additional headwinds for the stocks as we go throughout the balance of March. Healthcare had pulled back, starting to strengthen again. We're starting to see a little bit of relative strength in the healthcare. As long as that line continues to go up, that's probably a safer area to invest in right now. Consumer staples loves the month of March, kind of like utilities, and we're seeing some strength here. Of course, the S&P's been going down, so on a relative basis, that's what we usually see. We see strength here. So we normally see strength in staples on a relative basis when the market's weak, and of course, the S&P's been going down. I think come April, this is going to turn right back down and go lower. That's my belief. We'll see. Real estate started to strengthen a little bit, but overall, since April of last year, it's really been a struggle. We got 2 or 3 good solid months out of real estate, rolled back over again. We're below the 20, which is below the 50. Relative PPO negative. Still got a lot of work to do here. I'm not a big fan. Utilities, I'm a fan for the month of March. As I mentioned, historically, this is what utilities do in the month of March. We have outperformed. I mean, if you go back here to 2021, March outperforms. You go back to 2020, March outperform. Actually, It's actually showing relative weakness, but the relative strength chart or the seasonality chart says that it's outperformed for the last 5 months. So I don't know exactly where that is. Maybe it had a huge day at the beginning of March, and maybe March or end of February was a little bit lower. Maybe there was a slight increase. But anyway, we did have February, that second half of February, the big move up. We finished from mid-February to the end of March, certainly higher there. March of 2019 moved up, at least through the middle of the month before turning back down. And then you can see beginning here in 2018, look at that move in March, relative strength in utilities. So what we're seeing right now is typical. Again, I think maybe by, within the next week or two, we'll probably see that start to roll back over again. But utilities historically has been a pretty good area. And now I'm curious. I'm going to go in here and just check this seasonality out. I want to make sure I'm not dreaming something here. So XLU versus the S&P 500 last 5 years. Yeah, it's up 100% of the time. So I don't know exactly where it opened, where it closed, looking at that chart, but this is telling us that XLU outperformed the S&P 500 during the month of March, all 5 years, and it's averaged outperforming by 4.4% and still going this month. So that number could go even higher. Drag it back 20 years. Look at March, still the best month of the year for utilities. Average outperformance 1.4%. The next best months, August 0.6%, December 0.6%. So March clearly is the month that you want to favor utilities, and it's been that way again this month. All right, let's move on. Energy breaking down below its 50-week moving average. This is the first time we've seen this really since back in August of 2021. The last time we've seen energy this weak on a relative basis. Materials dropping like a rock too. These are areas that tend to do pretty well in inflationary environments. Not doing so well right now. What does that tell you? I know what it tells me, but I'll leave that up to you. Anyway, money is rotating. I mean, I'm not making it up. I'm showing you on the charts. Money is rotating to aggressive areas. Why would that be ahead of all this nasty market action that we're going to have the rest of the year? Wall Street disagrees. If you're bearish, I'm telling you right now, Wall Street disagrees with you. So good luck. Let's go on to earnings spotlight. We just have a few more minutes here. I wanted to go through a couple of these companies that are reporting or that did report earnings last night. So we're going to start off with Adobe. I'm going to go ahead and show it real time so we can just get what's going on this morning. Adobe beat 380 versus 366 on their bottom line. Stock up 5.7%. Looking pretty good. All the companies, by the way, last night that I saw and this morning, I've got 9 of them here on my list. All of them beat estimates. 9 for 9. FNV, this is Franco-Nevada, stock up 4% after slightly beating estimates, 86 cents versus 85. ZTO Express up 2.6%, also beating 37 cents versus 35. Speaking of 5 below, ticker symbol 5, down almost 3%. They beat, though, 307 versus 306. Path, which is UiPath, that they beat 15 cents versus 7 cents. Stock up 16% this morning. Pagerduty, 8 cents versus 2 cents, up 5%. Dollar General, 296 versus 294. Been in a downtrend. Stock down another 1.6% this morning. BEKE, this is KE Holdings, up 6% after blowing away estimates, 18 cents versus 7 cents. So it's back up to 18.27 to challenge these moving averages. See if we get through there. Last one I have for you here is Signet Jewelers. Stock up 4.5% after another beat, 552 versus 535. That's your earnings spotlight. Now we move into the 3 you must see to wrap up the show. We're going to start off with Oxy. Of course, Warren Buffett announced that Berkshire Hathaway has been buying more of Occidental Petroleum, and the stock continues to go lower, but it is in an area where we see a lot of support. We've seen many bottoms form around 54 to 56, even up here near 58, 57, 58. And we got to a low of 55.51 yesterday, closed at 56.80. This is an area where I would expect maybe to see some buyers at least take us back up to the 20-day. We'll see, but that looks like a legitimate thought for me. And then next, Delta Airlines. I want to just point out, and I talk about this a lot with our members and occasionally on the shows as well. We had a false breakout here. I don't like false breakouts. People ask me all the time, when's the best time to sell? Well, if I've gotten in, say, on a 50-day test and I go up here and I fail on a breakout, I don't ask any questions. I take my money and run. Look at what's happened since. Go back to December. Look at this breakout above this prior high and this high. False breakout. What happened? Back down. Be careful of the false breakdown, or excuse me, false breakout. As we get down here, support 31.32. I think you might see buyers coming back into Delta. Last one, actually, we already looked at that one. I wanted to look at Datadog. Datadog, not been a very good stock, but there is a lot of in-the-money call, in-the-money put premium. And as a result, this is a stock I think that could make a run over the next few days. We'll see it. This was a setup we gave to members back at the end of last week, over the weekend. And the stock has definitely started to turn back up, got right down to support. Watch that 20-day moving average. I think it could get up to there. If it does, I'd probably take my money and run. All right, that's it for me. Appreciate everybody tuning in. Make sure you check out earningsbeats.com. If you are new, go in and sign up for our free Earnings Beats Digest newsletter, or check out our service. We have a 30-day no trial offer there as well. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.